Ever feel like the world of money and finance speaks an entirely different language? You're not alone. Over half of people admit they don't fully understand even basic financial terms like inflation, GDP, or bonds. Yet, these aren't just abstract concepts. They're the forces that shape our everyday lives. Think about it. The price of your morning coffee, the rent you pay, your ability to save for the future, even your access to healthcare or education, all boil down to the workings of money. But here's something you might not realize. Financial jargon isn't just confusing by accident. It's designed to be that way. In How to Speak Money, John Lanchester pulls back the curtain on this confusing world and reveals an empowering truth. The language of money isn't as complex as it seems. In fact, once you understand the basics, you'll see how simple it really is. This book doesn't just explain what money is. It helps you navigate a world that's built around it, putting the power back in your hands. Let's start with a surprising fact. Financial terms are often created not to clarify, but to obscure. Why would anyone do that? Lanchester argues that the financial elite bankers, policymakers, and economists use language as a tool to exclude the majority of people. Terms like quantitative easing or negative externalities aren't inherently complicated, but they're made to sound that way. Why? Because complexity keeps power in the hands of those who understand the system. If you don't understand how inflation works, for instance, how can you challenge policies that affect your paycheck? If GDP is a mystery, how can you question whether it's the right measure of a country's success? The financial world thrives on this lack of understanding, but Lanchester flips the script. He shows us that once you start learning the language of money, you begin to see through the spin, recognize the truth, and take control of your own financial future. Take the term quantitative easing, for example. Sounds technical, right? It's really just a fancy way of saying printing money. After the 2008 financial crisis, central banks around the world used quantitative easing to pump money into the economy. The idea was simple. More money in the system means more spending, more investment, and ultimately, economic recovery. But here's the catch when you hear quantitative easing. You don't think about the long-term effects, like inflation or income inequality. The term is deliberately neutral, even positive sounding, which keeps us from asking tough questions. Imagine if the headlines had instead said, "Central banks flood the economy with new money, risking inflation." That would spark debate, right? This is just one example of how financial language shapes our understanding of the world and why it's so important to decode it. Let's dive into another example. Inflation. It's a word we hear constantly, but what does it actually mean? In simple terms, inflation is when prices rise over time, and as a result, money loses value. For instance, if a gallon of milk costs $3 today, but $3.50 next year, that's inflation. But here's where it gets interesting. Not all inflation is bad. Moderate inflation, say 2% per year, is actually a sign of a healthy economy. It encourages spending and investment because people know their money will lose value if they just sit on it. On the flip side, too much inflation or hyperinflation can be disastrous. Think of countries like Venezuela or Zimbabwe, where prices doubled or tripled overnight, wiping out savings and plunging millions into poverty. Lanchester breaks down the causes of inflation, whether it's too much money being printed, supply chain issues, or a sudden surge in demand, and shows us how this seemingly abstract concept affects everything from the price of gas to your retirement savings. And then there's GDP, or gross domestic product. You've probably heard politicians brag about GDP growth, but what does it really measure? GDP is the total value of goods and services produced in a country over a given period. It's often used as a yardstick for economic success, but Lanchester argues it's a deeply flawed measure. Why? Because GDP doesn't account for inequality, environmental damage, or quality of life. Imagine a factory that pollutes a river while producing goods. The profits from that factory add to GDP, but the environmental damage doesn't subtract from it. Or consider a natural disaster that requires massive rebuilding efforts. GDP might go up because of all the spending on reconstruction, but are people really better off? These examples show why GDP is a limited tool. It measures quantity, not quality. By understanding this, we can start asking better questions about what truly makes a country prosperous. Speaking of prosperity, let's talk about financial markets. Stocks, bonds, derivatives, these words might make your head spin, but Lanchester makes them accessible. Stocks are essentially pieces of a company. When you buy a stock, you're buying ownership, and if the company does well, your stock's value goes up. Bonds, on the other hand, are loans. When you buy a bond, you're lending money to a government or company, and they promise to pay you back with interest. Derivatives are a bit trickier. They're financial contracts that derive their value from other assets, like stocks or commodities. Think of them as bets on how those assets will perform. While these markets might seem far removed from our daily lives, they're not. A stock market crash can wipe out pensions, and rising bond yields can make mortgages more expensive. Understanding these basics isn't just about knowledge, it's about empowerment. The 2008 financial crisis is a perfect example of why financial literacy matters. The crisis was triggered by subprime mortgages, essentially loans given to people who couldn't afford them. Banks bundled these risky loans into complex financial products and sold them to investors. When the loans defaulted, the entire system collapsed. What's striking is how the financial world used jargon to deflect blame. Terms like credit default swaps and mortgage-backed securities made the crisis sound like a natural disaster rather than a man-made catastrophe. Lanchester uses this story to highlight the power of financial language. It can obscure the truth, shift blame, and prevent accountability. But once you understand the language, you see the crisis for what it was: a failure of greed, regulation, and oversight. Central banks also play a huge role in our financial lives, even if we don't always realize it. These institutions control the money supply and set interest rates, which affect everything from your credit card bill to the cost of a car loan. When the economy slows down, central banks might lower interest rates to encourage spending and investment. When it heats up, they might raise rates to cool things off. Lanchester explains that central banks are like referees in the game of finance. They don't play, but they make the rules. Understanding how they operate can give you valuable insights into why your mortgage rate just went up, or why saving money feels less rewarding during certain periods. At its core, How to Speak Money is about empowerment. It's about taking a system that feels intimidating and making it accessible. Lanchester encourages us to ask simple questions. Why does my bank charge these fees? How does credit card interest really work? What happens to my money when I invest it? The more you ask, the more you learn, and the less power the system has over you. Financial literacy isn't just about making better decisions. It's about reclaiming control in a world that often feels stacked against us. By the end of this journey, you'll see the financial world in a whole new light. You'll understand how the language of money shapes our perceptions, decisions, and opportunities. And most importantly, you'll realize that you don't need to be an economist to navigate this world. You just need to start learning the language. So, are you ready to take the first step toward financial empowerment? Let's dive in and start decoding the mysteries of money together.